I'm Kelly Jennings, CEO of Powerband Solutions. Powerband is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. Powerband Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are, and it's Friday, and it's been an interesting week.
And we'll remind people at the end of the show, or in our segment number 3, we'll have a question from the listener.
Indeed we do.
Bob, markets right now seem to be setting up a pattern where it's 3 days of decline, 1 day of advance. There must be a technical term for that.
Yeah, it's kind of unwinding a fabulous length of speculation. And one of the things that confirms a rising market, of course, is the advanced declines, where all the stocks in an index are, well, generally rising, and that's how one keeps track of it. And the one on the NYSE, I think it covers about 1,900 different stocks, and one wants to be bullish, and if the ADs are going up, that's very helpful. So, but they went up really good till, just like about August the 29th on the ADs, took a break, then rallied back into September, and then when it took out the previous low, it looks like August or September 27th, and this was a reversal in the ADs, and they've had a bigger decline than it was recorded in the January hit into February, or first of the year, when the .com bubble caved in. So this is important, Jim. The other thing we're getting with this is that the credit spreads have widened somewhat, but enough to say that we've got the second breakout on a turn to widening credit spreads, which is showing less confidence. And the yield curve, which, during the summer I've never seen so many stock pundits talking about the yield curve, and they were all revved up about that you're okay so long as it's flattening, and then it would go to inversion, where short rates are higher than long rates. And that is not necessary. We've got the yield curve in the U.S. back to, I think, about 1857. So you can get a cyclical change in the curve without it actually going to inversion. And this looks like what's happening here. It's, again, at this point, a warning. Then one of the other sneaky little ones, Jim, is the gold-silver ratio, which you think may not have anything to do with financial markets, but over more than 300 years, if you've got the gold-silver ratio, and if you know what's going on in the financial markets at that time, this is what happens. And with the ratio coming down, the financial markets can be positive, favorable, party time, whatever, and then the ratio will turn up. And it's been rising for the last number of months. And in September, when it first got a hit, it had made a new high, I think around 86. Then it's corrected since. But so we're watching the gold-silver ratio to move to a new high, and that would be suggesting that the party in the financial markets is taking another step to unwinding. And Jim, it really has been a party. You've had, you've had big volumes, you've had soaring prices, you've had strong trends, you've had high valuations, and the one we like is take the stock market relative to the average wage. And recent at the highs, it was higher, way higher than reached in 2007 at that top, and it was even higher than reached with the dot-com bubble that blew out in March of 2000. So these are excesses. And then at times you've had really good momentum surges, and that, of course, the one into January was absolutely incredible, because if you look at the New York Stock Exchange Composite Index, and it's got a lot of stocks in there, so it soared up and it reached on the weekly RSI, which is a measure of momentum, that got up to 89 in January. So as that was happening, it was so impressive. I looked back on the chart for the NASDAQ in 2000, which was an absolutely outstanding rally. And that same measure, the weekly RSI, it got up to 84. So then on that bubble, the dot-com bubble, financial newspapers were, reporting such sensational speculation. And here you had, within the broad New York Stock Exchange Composite Index, it exceeded the surge that concluded the bull market in 2000. So here you had the large index making that big peak in January. It corrected for a while, and then it sort of had a steady step-up rise until August, and then now it's rolling over. It hasn't broken down. But there are other influences out there, Jim, that we should review.
We'll have more with Bob Hoye right after the break.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Welcome back. We're speaking with Bob Hoye. Bob, just before the break, you said there are some influences on the market we should take a look at. Well, who are those influencers?
It's the outlying exchanges like Asian markets, Hong Kong, European stock market, and London. These also set their highs on that January thrust and have not gone on to new highs. As a matter of fact, in sort of a July thing, some of them set new lows, which extended the decline. Now, what we've found is that when you have financial problems in outlying exchanges, and if they're serious, they'll eventually work their way into the senior, the financial capital, which is New York. And actually, Jim, this one, there's a real old comment on this one.
This is where you get to quote Cicero, right?
Cicero. You knew it was coming. Cicero in Rome wrote that when there was a financial problem in the eastern provinces, meaning Phoenicia in the Middle East, that financial problem would eventually work its way to Rome. So here we are. You had in the summer these outlying indexes making new lows, and I guess 3 weeks ago wrote that this financial tsunami would soon hit the the ports of New York City, and they're kind of arriving. But this is sort of like when you get a tremendous speculation, and as popular and as enthusiastic it is at the time, that becomes an indelible event that you just can't undo it. So then you end up with the question, if it can't continue, which it didn't, would it turn into a plateau? Or will all of the excesses in the credit markets be fully corrected? And of course, you go back to 1929 when one of the leading economists then, Professor Irving Fisher, who was also a speculator, his theory was that if you look back on the bull market then that had started in 1921, that it would have a surge and then a plateau. So he just figured that the surge to September of 1929, rather than being a culminating event, would set up another plateau. And of course his theory was proved wrong, because you went into a severe post-bubble contraction and bear market. So here we are again, that you have people thinking, although I haven't seen it this week, but I've been watching for some named pundit to say, well, the markets are a little nervous, but it's okay because the Fed will cut interest rates. And then, of course, I'll bring out an essay from 2007 pointing out that throughout all of commercial history, in a boom, short interest rates, like the equivalent of treasury bills or treasury bills themselves, go up in a boom and down in the bust, and that you have the sharpest declines in short-dated interest rates in history have occurred with the worst parts of a bear market during, like when you get heavy liquidation. So this, I'm hoping, Jim, that this comes out, because there were sure a number of them in 2007 where they were talking to the street and saying no problems because the Fed will cut rates. And the Fed did cut rates and went all the way down to zero. Same as what happened following the 1929 speculation. You ended up with effectively zero interest rates by the time you got to 1932. So we live in very interesting times.
I was just going to ask about this, Bob, where people say, oh, the Fed has our back this time. How many recessions have happened since the Federal Reserve was invented?
Oh, yeah. Good question, because in reading about the history of the formation of the Fed, it was basically some nervous bankers, investment bankers, commercial bankers in New York who thought that with having a central bank, that it would, as you say, back them up. So the U.S. had previously had two problems with central banks, so they couldn't call it a central bank this time, so they called it a Federal Reserve System, which was a cheat. So the argument for it was that they then knew that recessions followed, a setback in the financial markets. That's been the case through history. So then they assumed that the Federal Reserve, with its, and the concept has always been called the lender of last resort. So they're there to prevent a bank or a company that has a problem from afflicting the rest of the market. But the problem with that one is that everybody gets speculative at the same time, gets overextended, and then the market becomes exhausted and it comes down. So the Fed was formed with a theory that it would prevent setbacks and therefore there'd be no recessions. So if you get the National Bureau of Economic Research, NBER, they're the official designator of a recession or a boom. Hey, since the Fed opened its doors, Jim, in January 1914, and there's been 18 recessions since. So when does the economic community sit there and look at the evidence and say, it's not working? And it isn't working. It's not doing what it was designed to do. So all it's done is become let's call it a broker for the government. And then the other thing it's been forced to do is actually provide endless funding for an experiment in unlimited government. So the Fed has been trying to provide unlimited money to an experiment in unlimited government, and on the financial side, it's lived on a series of financial bubbles, because, hey, they make money in taxes during a bubble. And if this bubble fails at some time, inevitably, prosperity will disappear. And actually what will happen is the public will look at the promises of the financial side and the central banking side and say, you've wasted trillions of our tax dollars in trying to prevent bad things. And that, of course, will come out in the midst of bad things, so it'll be ironical, but I think it'll also be part of the popular uprising that is going on, whereby, at least in the U.S., started earlier than in Canada, the public are trying to get control of government out of the hands of experts and bureaucrats, and it's trying to get back to government by the people, and I think it's making remarkable successes. And the other part of government by the people would be to prevent the state from screwing everybody by depreciating the currency. So at some point, the public will demand, and it will get, a gold-backed currency, sound money. I'm convinced it'll happen because it's happened in the past. So, Jim, we live in very exciting and very interesting times.
Stay tuned. We have a listener question coming up right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, our listener question: could this correction eventually lead to corrections similar to 2000 and 2008? Many forecasters are predicting a 20% correction, some cases a 35% correction, but many have also said the correction would happen after the Dow hit 40,000. But the market right now is so overextended, why not a 50% drop or even more?
Good question. I like the mention of the target of 40,000. We could be both thinking of the same guy, and I heard him on a show on the weekend, and I thought he was about 5 or 6 months out of date because he was still talking that this is the most hated bull market, and that there were too many people, doubting it, that sort of stuff. So I don't think that work is that well qualified. And let's just look at what is happening, and it's very similar to the peak in 2007 from less speculation, and it's similar to the peak in 2000 from as much speculation. So that has to be corrected. And now here's a way to look at it is, for example, in 1929, the Dow Jones fell in the full bull market, which ended in July 1932, it gave up something like 87%. And it was a much more junior market then relative to the senior market in London. And the London stock index, you could say it fell in half, or 48% or something like that. So then we move ahead to 2007, which was a pretty vicious contraction. And the S&P gave up 48 or 49% because it was a more senior market then. And but you could certainly find any number of stocks that had given up 85 or 90% or more. So what one wants to look at in answer to this question is the immediate decline, and I don't think you can really put a percent on it. Certainly more than 15%, maybe 20%. But the main thing is the timing on it, where in the past, where you've had like forced selling, which there still could be some more left in here, it can sort of get heavy in October, what's left of October. And then on the number of these declines, they sort of can get tested in November. So we think the financial markets can be subject to some storms through into November. And if one does come in by then and things get oversold, we will probably have the technicals that'll help us get back into the market, because there'll be some bounces. But the probability is that this huge financial bubble has fully expressed itself and is heading towards let's call it a lengthy contraction. Good question.
Bob, Mike Shedlock has a theory. He said it's not fully worked out, but he thinks because companies got so lean and mean after the last recession, and right now there's a labor shortage, he thinks they won't really lay off that many workers if there is a recession because they're so hard to get back.
Yeah, that's boom stuff, Jim. I think we want to focus on when we get post the boom, past the boom. So, yeah, and also at the end of great financial bubbles like 1929 or 1873, the economy turned down more or less coincidentally with the financial markets. And the explanation for that is that so much of the economy is dependent upon financial speculation, and it can do it whereas in more of a normal bull market, like everything prior to the last 20 years, well, no, even 2000 market, usually you have a peak in the stock market, and the economy keeps going up. And the high in the stock market can be 10 to 12 months before the economy actually tops. As a matter of fact, the conference board in the last couple of days came out with their leading indicators, and they still have the stock market as a leading indicator. When you're in bubble land, the stock market turns down immediately with the economy, or the other way around. So the stock market is no longer an leading indicator. So this recent report is a bit suspect. But yeah, Mish is right that it is a boom time now. But if this financial markets erode further, the boom will disappear rather quickly. And this is what we're talking about here, is the transition from one of the most outstanding bubbles in history. And you're talking about powerful forces at work, but what we see in industrial commodity prices weakening, that's a negative. The only thing that's keeping things up recently has been crude oil, which, Jim, may have fallen into an old seasonal pattern whereby you can have an important high in late September, early October, which we've had, and then no matter what seasonal pattern is on through kind of like the summer months, the seasonal will be for a distinctive low for crude oil in December, January. We think it can be quite dismal because it's been quite speculative. So the thing to do is watch crude oil very closely, and if it extends its decline, then you will see widening credit spreads because of a huge amount of junk bonds written in the petroleum industry, and then it spreads to other junk bonds. So we're watching these things rather closely.
Bob, thank you so much for being on the show.
Yep, good to be with you, Jim, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob or any of our other guests, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.